Hello, everyone, and welcome to UBS Trending. I'm your host, Anthony Pastore. As we look towards the last few days of 2022, we consider what markets might look like in the new year, particularly when it comes to fixed income investing. So things like, where will rates be? Will inflation continue its rise? And most importantly, where are the opportunities for investors? We're going to talk about that right now with my colleague and friend, Leslie Valconio, taxable fixed income strategist, head of taxable fixed income strategy for CIO. So Leslie, great to have you.
Thank you.
A lot to get to. It's been a while since we had you in the studio.
It has been.
And now we're talking about 2023, which is almost hard to fathom. I think even our viewers are thinking, wow, it's the end of the year already. How did we get here, right? But you, on the CIO side, you just all, as a team, released the Year Ahead 2023, which for our viewers watching today, it's a publication that we're going to be talking about a lot over the next couple of weeks on this show, on this series, but chock full of ideas and strategies and thoughts about the year ahead into next year. But today we're going to talk about fixed income rates, et cetera. So I want to start with the idea that in the year ahead, the CIO expects that year-over-year inflation has maybe topped out a little bit, perhaps even hit its peak. There are a few factors that indicate that. Wage growth, you've also got future inflation predictions, what Jay Powell has been talking about. Given that, where do you expect interest rates will be, let's say for the first half of 2023 as we look towards the next few months? Where do you think rates will be?
You know, one of the interesting things, particularly when you look at 2022, just the amount and the magnitude of interest rate volatility, right? That's been a huge headwind to total return for most fixed income assets. And when you think that we started the year in 22 at a 1.5% 10-year Treasury yield and went all the way to 4.35, right, a month ago, okay, in 10-year Treasury yield. Mm-hmm. Now we're at 3.75-ish. So when you go from 4.35 to 3.75, you've rallied 50 basis points in almost a month, just a month. This kind of interest rate volatility we really haven't seen in decades. So when we think about what we're going to see going forward, we do expect interest rate volatility to come down as we get close to the Fed, pausing its rate hikes. But also, too, it's going to depend on actually where we end the year. And I want to emphasize that because, again, we've moved 50 basis points within a month, and we have a lot more data from now until year end. So it's our expectation, though, as we go into, say, the second half of 23 to be around about that 3.5% level 10-year yield, and then trend lower in the second half of 23. So the first half we go to 3.5. The second half we'll go to around 3%. Now, will that 3.5% that we think for the first half of 23 be higher or lower? It's going to depend on where we end the year. Mm-hmm. And our expectation is that we can end the year at around a 3.5% yield, right? So we're at 3.73 right now. You can't really take that off the table because we have a lot of data till then. It's year-end window dressing. So you could be 3.5% at the end of the year, 3.5% in June, and then trend lower.
That's right. And it's interesting because obviously we have another Fed meeting coming up, the last before the end of the year. Expectations are that perhaps Powell and the Fed may slow down the pace of tightening, but not completely, obviously, cut it out. And as far as I understand, the CIO prediction is that they won't be completely doing away with tightening until either later next year or early 2024. But in a worst case scenario, inflation really is the word that we're always focusing on. Look, there still are China lockdowns. And when a lot of us experts, not me as an expert, but a lot of us and experts were expecting that China might open up, we just heard recently that they were going to keep the lockdown for the foreseeable future, which could potentially provide a worst case scenario for the markets where, we might still have more supply chain issues going into next year. What does that worst case scenario actually look like then when it comes to inflation and the prediction for 2023?
Well, when we think about inflation, and it's important for people to note the difference, is the Fed's target is 2%. But it's not 2% for 2023. That's a longer-term target, right? So what they need to see is inflation coming down, right? And that's really the key. To your point, if inflation doesn't come down and it moves higher, right, that's where you're going to get a lot of headwinds to the marketplace. And what I mean by that is the market does expect, as do we, the Fed moves to let's say around a 5% terminal rate, which is the rate at which the Fed feels comfortable that it's at least close to meeting its dual mandate, employment and price stability, which is really only one mandate right now, inflation.
That's right.
So, but it's close to that. So say that's 5% by, March, April, okay? If, in fact, inflation doesn't trend down, again, doesn't have to be 2%, but it has to show that it's coming down, then you're going to see more rate hikes priced into the marketplace, right? Then that terminal rate moves from 5.25 to possibly 6%. So what does that mean? Well, first off, we know that we've seen already in the marketplace those sectors that are very sensitive to interest rates, like housing, the mortgage rate. We've seen a lot of headwinds to housing. We've seen certain headwinds to the consumer because of that higher mortgage rate. So that's already come into play, and that will, and in turn, if in fact the rates have to move higher, the Fed fund rate will become increasingly worse, and consumer demand will come down very fast. So will they put that into recession in that level? It's really going to depend on the data, but that is obviously something that would be very restrictive if they have to move the Fed funds rate even higher, tighten financial conditions even more, but it's really going to depend on the slack in the labor market, how quickly they can bring down consumer demand. But one thing I will say as well is that when we think about U.S. interest rates, for example, we have 3.5% at the end of the year, and that doesn't mean that you can't go back to 4% in the first quarter. But if in fact our projections, or say what the market is pricing in, which is about a 5.25 by May, are correct, then there'll be a cap as how high those interest rates can go because the market's expecting that pause. If that doesn't occur, because to your point, inflation's running higher and that terminal moves up, then interest rates will initially move much higher. So in terms of, to your scenario where inflation keeps moving higher, the Fed will have to keep moving higher, which will tighten financial conditions and I think really have a pretty profound effect on economic growth.
I was going to say, and as of today, or as recently, Jay Powell came out and said it was a good thing that there were fewer job openings because obviously the more people getting jobs, the economy's continuing to grow. They have a mandate, as you just said, between employment and inflation, really focusing on inflation more these days. So it seems like, according to Powell and what he just said in this quick interview, was that it seems like jobs are kind of moving in the right direction for them to continue to slow down the pace of tightening. So and like you just said, there's more data to be analyzed as we progress towards the end of this year and certainly beginning of next year. Obviously, we can't predict what might happen with China or inflation picture in general. There's still the energy crisis in Europe because of the Ukraine war. So there's a lot of factors that are out there. So obviously, we'll have to wait and see a little bit. But I'm glad you at least painted that scenario as hopefully a slim possibility at this point, right? All right, so let's go on to the fixed income portion, which really dives into, we're in this uncertain market environment. We all know about this. This has been going on for some time. So investors are looking, I would say, for maybe more predictable returns. So what are you recommending within the fixed income investing environment for investors who do want that more predictability?
Well, I mean, listen, the fixed income in 2022 we know was a very difficult year. I mean, some of these returns were worse, as we've seen since the Great Depression. But we're moving to this TINA. There is no other alternative to Terra. There are other, I think it's reasonable alternatives. And this is really the case in terms of fixed income because the yield that you're earning, the opportunity set is widening, right? Which provides investors a lot of cushion in terms of what we might see going into 23. Now, with that said, when we think about the volatility and some of the headwinds, the returns that we saw, or the negative returns that we saw in 2022, were really due to the rise in interest rates. And what I mean by that is, yes, we did see spreads widen in credit, things like high yield and senior loans, but it wasn't really something that was abundant. So most of the negative total returns were due to a rise in rates. So the compensation in terms of risk premium, if you will, for investors, really isn't that large heading into 23 for those that are in deeper credit, okay? When we think about the stability of returns, however, and this is really where it's key because we went from 1.5% 10-year yield to 4.35, let's just say. It's very unlikely that we go from 4.35 to 8.60 in 10-year yield, right? So you're not going to have that sort of headwind of that drag on total returns due to a rise in interest rates. So interest rate volatility should come down. Now, those sectors that are really highly correlated to interest rate volatility are those that are easiest to mark to market and those that are more liquid. Agency mortgage-backed securities, investment-grade corporates. If you have large redemptions in your funds, you sell the most liquid assets first to meet those redemptions. So when we think about, the stability of what we can really earn from those types of sectors that are higher quality and have, great yield and great carry, we think is a very good, risk-reward heading into 23. There's no question. I mean, one, because there's still a lot of unknowns. Two, because you're earning anywhere from 6 to 7%, yield in the long run. And as we know, and as we will probably continue to see through at least the first half of 23, the yield curve is inverted. So I have higher short end rates.
Been inverted for some time.
It's been the 2s10s have been inverted since March.
That's right.
Okay, so I have higher short end yields, versus, say, longer yield. So a 2-year yield is higher than a 10-year yield. So part of what you could do with that as well is go into these, these sort of shorter assets, whether it's, IG corporates or things that you earn carry.
Yeah, short duration bonds, right? Is that what you're thinking?
Yeah, exactly. Short duration, either outright or a ladder or a fund that you have, the things that you could have in terms of I can earn carry, have capital preservation, and as we know, the market is pricing in that terminal now, right? So we're not going to say the 2-year yield won't move higher at all, but the majority of the rises are in the marketplace, and that's really the whole point. So you'll have stability from that end, and also too, those that are willing to take on a little bit more interest rate risk as the cycle matures. Long-end corporates, agency mortgage-backed securities are offering great yield, and by the way, are up in quality and offer much more liquidity.
What about investors who want to take on a little bit more risk? Because looking at the year that we've had, all this uncertainty and the volatility and inflation has certainly led to a bit of a sell-off in some of those riskier credits. But is there still opportunity out there for those investors who might be able to take on that kind of risk?
Well, I think that for those that want to go into more credit, you don't go in the public market, you go in the private. So you do things like things like alternatives, which offer you that sort of great carry. Again, you have to be selective about the fund and the percentage of allocation, but those types of sort of vehicles provide investors actually very good total return, particularly when the public market could be underperforming. Again, you have to be cautious and careful what you select and the amount, but and you have to be willing, as we know, there's a liquidity premium to that. But overall, those sectors have a tendency to outperform.
Right. And then sector-wise, we're looking at energy, we're looking at consumer, discretionary, right?
Yeah.
Terrific. Leslie, thank you so much. It's always great to get your take on these things as we're sort of getting ready for year end and thinking about how we can look at our portfolios for the new year. Great to see you.
You too.
Thanks,
Thank you.
Leslie. Leslie Falconio from the Chief Investment Office. And for more information, you can visit our website, ubs.com/views, and you can follow us also on social media. We're on platforms like LinkedIn, Facebook, Instagram, and Twitter. Plus, all of our past UBS Trending episodes are available currently for you on demand, so you can watch anything that you might have missed. And as always, if you have any questions about your portfolio, especially with, as we were talking about, some of those riskier credits, you definitely want to have a conversation with your financial advisor about how it fits into your own risk profile. Until next time, I'm Anthony Pastore. We hope you have a great day, everyone, and remember to keep your eyes on what's trending. We will see you soon.